KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show this week. KCAA is our station, and we're very excited to continue our long-term relationship with these people. Fred, really appreciate all the work you do, bringing us not only to your celestial audience and your AM, FM stations, but also to the great podcast that you allow us to come to each and every week. I know there's many of them. We won't get to them right now. We're also on a great a great website. It's themortgagevoice.com, as well as a number of other different outlets for the show. But suffice it to say is, Happy New Year. Daryl, Happy New Year to you too. I don't know if you're on air, but
I certainly can be. Thank you so much, and I appreciate it.
Yeah, thank you. No, I'm glad we could do it. I mean, it's shaky here, and as everyone well knows, anybody in the real estate and mortgage business will tell you, it has been a tough last 6 months. And the reason is because it's uncertain as to when the rates will either get steady or come down more, or obviously going back to the rates. At the beginning of last year, we were at a certain number. Now we're at a different number. We've seen rates climb as high as 7.5% on a 30-year fixed-rate loan. That's a huge jump from 3.5%, which it was in January of 2022. But we're in 2023. We're looking to a number of different economic factors to affect rates, as well as how rates are affecting purchases and what is happening in the inventory. If we want to just talk rates, let's just set the stage here as we try to figure out what's going to happen this year and where your particular needs are going to be met if, in fact, you plan to buy or you want to get out there and refinance this year. So the rates on the 30-year fixed, currently 6.54%. You can shop around depending on whether you're an A-paper borrower. And what do we mean by that? We mean if you have a FICO score above 800. And on a quick aside, I had a child of mine in a particular place who needed a co-signed parent. Anybody who's a parent knows what that is. You co-sign on a lease and make sure that there is somebody who can qualify. And my particular credit score for the first time ever was above 800. So I know what that is and how it can affect your ability to get a loan. But if you're in that particular group, this particular rate at 6.5%, let's say on a 30-year fixed rate, is for you. If you're in a credit challenge group, and that would be anything in the 600s, 620, 640, 680, you will not be getting that rate. That's just the way it is. Rates often determine, credit score often determines the type of rate you have and the type of rate you're going to get. On the 15 years, a 5.87, and I love the 15, as everyone knows who's listened to this show over the number of years we've been on air here at KCAA. That 15-year, if you can afford the extra amount of money it's going to cost you it's just a great product. One, you're over in 15 years. You own the house. It's owned outright. And two, you get a much better rate. Obviously, the difference between 6.54 today at a 30-year fixed rate and 5.87, well, that's a significant amount, close to, well, not close, but pretty close to 3/4 of a point. And that over the 15-year term can really save you a ton of dough. If you add in an extra payment a year, that also is a way by which you can buy down the principal of your loan and get an even lower payment over the term of the loan. The FHA loan is at 6.15. The jumbo loan is at 5.70, and the 5/1 ARM is at 6.20. All of these loan products are at least off their highs of last year. We are several months away from the highs. I think the high in a lot of these places, a lot of these particular products, a lot of 30-year, 15, the FHA, the jumbo, or the 5/1, they were all at their highs. Let me look at this. I have it here. I think it was, in June of last year was really the high, June and July, when we saw rates really soar. We did see rates fluctuate quite a bit over the last half of the year, but in June, July, August, we started to see those particular prices at 7.5%, which is really high, and that's when most of us in the business were contemplating other careers. Now, I make a joke of it, but in our section of the economy, real estate, mortgages, which kind of go hand in hand, of course, we see that about 1 in 9 workers in the U.S. work in this space, whether it's escrow, whether it's title, whether it's mortgage origination, whether it's real estate agent. Any of these combinations, plus all the ancillary businesses that go along with it, escrow, and you also have home inspections, and you have all kinds of people that work on properties that are bought and sold when they're bought and sold. Those are all affected as well, and all a part of that 1 in 9 that work in the real estate section, real estate sector of the economy. Now, many places in the U.S. have seen an enormous rise in prices since the beginning of COVID. Now, when was the beginning of COVID? Daryl, you got the beginning of COVID?
The beginning of COVID was approximately 2.5 years ago.
Was March of 2020.
Okay.
So just about almost 3 years ago. And what we've seen in both the availability of the housing and the cost of housing has really, and it's unknown why it happened. The only thing you can say as to why it happened is because there wasn't enough and there was plenty of dough out there and the economy was growing. So people felt good about themselves. They had money in the bank. The government was handing out money, and there was low interest rates. All of these things created the environment that shot prices to real estate through the roof. Really unprecedented amount of increase in the value of your home. Now, let me see where that particular... Okay, housing prices, October 22nd this year, were 38% higher than in March of 2020. That is unbelievable, almost 40% higher. Now, we are talking this year in 2023 about a little bit of a recession. Now, I say a little bit of a recession because in listening to the many financial stations that I do listen to, as well as the research that you do for the show, it looks as if we may have already been in a recession when it comes to the stock market at last year, or when it comes to negative growth, which we had 2 quarters in a row in 2022 when there was that fight of whether you were in a recession, whether you're not in a recession. A lot of people think that actually we were, and now we're coming out of the recession. And coming out of the recession, what are we looking at the parameters or the different milestones along the way in order to make sure that the economy is growing? There's employment, there's GDP growth rate, there's the availability of figures from the Fed about whether inflation is under control or whether it's not under control. Are we going to get cuts in the interest rate from the Fed on short-term interest rates that they lend out to member banks? Or what are we going to be able to gauge where we are now and what is going to happen in the future when it comes to what we're doing about the economy? Are we in a recession? Are we not in a recession? All of these things that we look at when we're trying to figure out, okay, you're the consumer out there, you're looking for a home, you want to know if the economy is going to be in good shape, if you're going to be able to keep your job, get a better job, if wages are going to continue to grow, or if we're in a typical market whereby a recession comes in. Now, I say typical market. What I mean by is when we go into these downturns in the economy, when the Fed is squeezing monetary prices because they're raising rates. Let's face it, if the Fed goes from 25 basis points up to almost 4.5 percentage on a short-term interest rates, that's going to squeeze the amount of money that's available to the economy. It soaks up all the excess money that's out there, and what does that actually do? It creates a lending issue for consumers. Consumers are going to have to pay more. Mortgage rates have gone up. So if you're out there and you're looking for a home right now and you're trying to figure out, can we afford this? You have to consider all these things. Okay, are we done with the interest rate hikes by the Fed, which tangentially affects what goes on in the mortgage rate? That's a question you have to ask. Are prices in real estate going to remain as high or continue to grow, as some people have said? Or are we going to get a cut in real estate prices? And is now the best time to buy if, in fact, we're going to see a 10 to 20% reduction in price over the next 4 to 6 months? Can we afford it financially if mortgage interest rates don't fall to 5% or 5.5%? All of these things are in your consideration and the wheelhouse of what we do on this show each and every week. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show and listening to us each and every week. You know, we've been on air for 8-9 years. Really appreciate the people and the work that all the stations and all the different podcasts and people who listen to the show bring to it. And it's not simple to just each and every week say, hey, you know what, we're on the air. But Daryl, who's been doing it for, how long have we been doing this? 5 years, 6 years, 10 years?
It's somewhere between 4 and 6.
4 and 6 years. And how many shows?
400 and
Oh, man.
something, four and change.
Oh, it's a huge number. Anyway, thanks, Daryl. I appreciate it and appreciate what you do each and every week. Thank you.
My pleasure.
Okay, so let's get into what we were talking about a bit earlier in a different segment, choices for consumers on getting loans and how they have to make decisions based on a very iffy market. Listening to some of the financial channels, it's very interesting because there's a built-in symbiotic relationship between all the parties involved. And I think we get that way in the real estate and the mortgage world as well. For instance, if there is a sentiment, wherever the sentiment comes from, in the mortgage business, usually business is bad, this is terrible, it's not going to work out. The entire focus of either the people that are looking to help you get a loan or the people who are pricing out getting the loans all have this in mind, that somehow what's happening is not going to help you get a loan. Therefore, not only will you not get the loan, but the people who are doing the loan get depressed, and the entire sentiment really turns sour. And that's a bad thing to do, especially when you're talking to consumers who are looking to you for advice. Now, in the financial world, you have economists, advisors, and people who sell you stocks. These are the three levels of what we would consider to be experts in the field. Now, if the top people, the economists, have a viewpoint, and it's a spectrum, right? There are all kinds of viewpoints. But in general, there is a consensus. There are some outliers, but for the most part, they have an idea as to where that particular stock or that particular group of stocks is headed, or the market in general. And it's picked up by the advisors, and the advisors advise their particular salespeople who are on the phone to you, their FCs on the phone to you to sell you a stock. Well, in the real estate and the mortgage world, it's very similar to that. What the consumer sees, whether it's at the Fed, and again, the Fed has nothing to do with mortgage rates, except that there is a sentiment, and that sentiment actually does affect mortgage rates. In the mortgage world, you're talking about lenders. Now, I listened to a guy, Kevin Perino, and he's a chief lending officer over at PRMG. Very smart guy. He's got a great online presence. He just has a very down-to-earth way of explaining things. And he talked about this earlier on a podcast over at Housing Wire, which I listened to. And Housing Wire, by the way, if you want to know and find out information in the mortgage business and in the real estate business, Housing Wire is a great place to go. I go to there and mortgage. What's that one I go to? I don't even remember. It doesn't even matter. So Housing Wire is a great place to go to. I've been out of the circulation of not only talking about this stuff, but also conveying the message to you as a consumer or to my friends exactly what it is. It's Mortgage News Daily. That's what it is. And so in listening to Kevin, he talked a lot about the sentiment out there in the mortgage world and how that is a snowball effect on not having people, when they talk to customers, be excited about the products that they can offer. I maybe not be able to help you because you can't afford a 6% mortgage, but I can tell you about 7 different products which are new to the marketplace, which will bring you to a place where you need to get when mortgage rates either come down or you have more money to invest either in your home or your investment property. And these are the types of ways to talk to clients to get them considerably more information in a positive way. If you receive information in a positive way, you're more likely to remember that there are solutions in any market, especially when you want to get out there and buy. So we talked some about the rates where they are today. They're not at their highs, but they're certainly not at their lows. We talked a little bit about inflation. The inflation where it is today is 2 months into a downward trend in the CPI, the core inflationary price. And that's a good thing, because what we want to see is a continued downward trend in inflation. Now, many people who are listening to this have never been through an inflationary cycle. I've been through a couple of them in the 70s and the 80s. There were 2 different time periods where it was bad, and it is as bad today, because what costs today, I mean, back in 73, when I first got introduced to inflation, and there were long lines at the gas pump and all kinds of different things, and we had a president, and President Nixon, who had to freeze prices and freeze wages. Think about that for a second. Do you think that for 1 second could happen today? You can't get people to get in line to get a vaccine. How are you going to get people to get on board if you freeze their wages and freeze prices? It's just not going to happen. So in this particular market, in this particular cycle, what we're dealing with, in order to help you understand, is this a good deal to buy this house now at this particular rate? So we talked a little about Kevin and his positive attitude. We talked a little about how in the stock market you have 3 levels that really make up the world of investing, and they feed off of each other and complement each other to a certain extent, to whereby that's your universe. In the mortgage world, it's really about rates, and it's about the cost of the house, or the price of the house. If you can make those two in more of a, I guess, symbiotic way. For instance, if rates go up, prices come down, you can still afford the house. If prices go up and rates come down, you can still afford the house. Currently, and in the last half of 2022, we were in this cycle whereby, no, what happened is we had prices go up and we had rates go up. So fewer and fewer people could afford the mortgage. So what do we have now? We have prices coming down a little bit. And we are predicting, not me in particular, but I think last year, at the end of the year, I was predicting that 2023 we would see a recession, and I thought it would be earlier in the year than later in the year. Maybe it's Q3, but I still think there is one coming. And why do I say that? Because most of the people that I read about and most of the businesses that I talk about are preparing for that inevitability, which means layoffs. And where would the layoffs come? We've already seen the layoffs come in the tech sector. We've already seen the layoffs come in the financial services area and in the mortgage field. So these particular layoffs that we've seen, and I listed them, I don't know, there was like 25 to 30 that I listed in the financial sector at the end of last year, anywhere from Wells Fargo to Apple to United Wholesale to Quicken Loans. Every one of these industries, every one of these businesses, they laid people off, and as a result of that, this is where we are. So have we seen an uptick in the unemployment? That's the one marker that we have yet to see fall, if in fact we are going into a recession, which I think we will. So all of these things together, you're sitting at home, you want to know, okay, great, Jeff, what does all this mean for me? I'm wanting to buy a house. I have a good job currently, and I think what we're going to do is see a little bit of appreciation in the house reduced, maybe even prices fall next year. Should I be buying that house? I would say you got to wait till the prices fall. Now, I know this is bad for me, it's bad for my market, but at the same time, prices falling on the house you want to buy by 15 to 20%, which could happen in a lot of different markets. I'm going to tell you right now. Prices to fall in COVID boom towns. Now, we all know what COVID boom towns, those are the prices because at-home workers stayed at home or moved into areas that they wouldn't necessarily have moved into. The boom towns themselves, these places where housing prices will fall the fastest, predicted not by me now. Austin, Texas, Boise, Idaho, and Phoenix, Arizona, all big markets, all saw huge 50% increase in their prices. They're now predicting that these particular markets, as well as others, and if you need to find out whether your particular area is on that list, hey, give me a call. Text me, write me. I'll let you know if it's going to be in your area. Now, the KCAA audience is in San Bernardino, Riverside, and in those particular areas, there are pockets that we're going to see some reduction in prices. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for tuning in each and every day. We bring this show to you on a weekly basis. If you want to catch it, video of me talking to my guest as well as, spouting off about whatever I have to say, you can go to YouTube, Jeff Barton, the Mortgage Voice on YouTube, and we've got hundreds of shows there. You can obviously archive and see anything you want, but the current show will be up and ready to go probably in a couple, 3 days. We talk about local goings and doings in the mortgage and real estate world, as well as the macro, what's happening nationally, internationally, that may affect the way you make decisions on whether you're going to purchase or whether you want to refi or what's going on. Maybe you should even wait. With me today is Connie Hernandez, who comes to me from PMA. Been with me many times on this show out in West Covina, and she joins me again today. Connie, Happy New Year. Thanks very much for coming on the show.
Happy New Year, Jeff. Thank you for having me on the show. Always a pleasure.
Always. Thank you, and I appreciate that. You know, it's been a kind of a I had a lot of stuff go on personally. I got COVID, and I was in a number of different events towards the end of the year, so it was an overwhelming situation. Do you feel overwhelmed at all in this mortgage environment?
Oh, sure. Absolutely. I can't imagine anyone not feeling overwhelmed.
Mm-hmm.
It's a lot to take in a very short amount of time. It's almost like it's a different situation, but if we go back to the crash where everything happened so quickly.
Right.
And, we had to learn to react very quickly. And those of us who've been around for a little bit, we're still around. So, thank goodness that we've taken good care of our clients over the years. So we have those referral clients that we really love and depend on. So with that being said, yeah, absolutely overwhelmed. The interest rates, the way they just adjusted so rapidly, I'm sure was
right.
Not just a shock to the little guys or the mid-sized lenders and brokers, but, major shock to the big guys as well, like lots of layoffs, sad to hear, but, there's always those adjustments that we have to learn to go through.
No, I think all of that is true. And how are you helping your clients today kind of sort their way through all of this? Certainly there are products and there are opportunities in every market. And now we in the profession say that, but I think it's also true. And we're not just saying it to drum up business, but I think there are a lot of opportunities if you have the patience and also the loan officer or somebody who can show you different options to be able to take advantage of what is out there.
Well, you're absolutely right, Jeff. I mean, we're in an industry where it's up to us to understand the market and also guide our clients through situations that they may have. Now, obviously those people that were, I don't want to call it smart enough, but that seen the market and took advantage of those low interest rates. I mean, their interest rate is so low. Mind you, if they refinanced on a rate and term, their interest rates are probably in the low twos, maybe close to the threes. So now, if they see that they have a possibility of adding an ADU to their home for that extra income, doing those upgrades to their home that they may have needed and put off, they can still get a second, and it's still within reason, because if you really look at their loans blended, it's still not a bad deal, right? And those clients are always going to need us to guide them, find the right second, find the right HELOC. There's a lot of people that are, obviously the baby boomers, they still need help with their reverses. And there's so many options out there. It's up to us to be able to guide them to get into the right option for either the reverse or the HELOCs, the seconds. And I am actually getting still some buyers. I know rates are a little scary for some people, but ultimately, and you and I both know this, we've been around so long, 3%, 6%, 7%, it's all relative to, if your payment is, let's just say $3,000, and you send an extra 100, how does that affect your rate long term? If you can afford that extra $50, $100, you're truly not paying that full 6%, right? If you really look at the overall long term picture. So it's all relative to us being able to explain what those options are.
I wanted to get back a little bit to the ADU. I think it's a very interesting way by which somebody can get another unit on their property and maybe rent it out, or be able to bring family homes, so that they're reducing their overall cost outlay, that they might be helping the other person get a rental on another property. So you have equity in your property, you have the ability to get a second, and then you have obviously the blended rate. Could you explain a little bit about how you would talk to a client about getting a second to build an ADU, given all those parameters?
Well, most definitely. I mean, you do definitely have to do your research and also be able to talk to a broker that understands what the ADU options are. There are some really good opportunities out there for people. It's a very big difference if you're building an ADU from the ground up versus converting a garage. Could potentially be that extra income.
Right.
Now, again, if you have a very low interest rate and now you have all this equity in your home, and an ADU, it is based on future value. So that's a huge plus. People are probably not aware of that. The ADU, the interest rate is obviously going to be a bit higher, but if you really look at it, you're gaining that extra income otherwise you wouldn't have. Not only are you getting immediate income to offset that cost of building the ADU, but it's also future value on your property. So if you come to a point where you're retiring, you're downsizing, you've added so much extra value to your property. So I really strongly believe that there's an opportunity for you to add an ADU, whether it's converting a garage or you have the space in the back of your home where you can convert it to a nice little one bedroom.
Right.
It's an opportunity that should really be looked at.
I love the ADU, and for people out there, ADU is additional dwelling unit.
Yes.
It's like a guest house or a granny flat or whatever you're calling it in your particular neighborhood, casita. But in the overall scope of how it adds value to a house, I love it. I love the fact that you can, convert something that you already have to that. There's a number of different ways by which you can get that into the property. In my particular area, because it's in the coastal commission zone, my particular city is dragging its feet. They don't want to issue permits for ADUs, which makes me insane, because Los Angeles County and a lot of the counties, Riverside, San Bernardino, have already said that this is the way to move forward with. If you want that, it is okay to do, because housing is short, and relative to what we need in terms of housing in general, and we just have to increase the number of housing units on the market. So again, I love the way it is. And given that, what do you see in the real estate market out there in your particular area? Are we seeing any new additional properties come on the market?
Well, that's kind of slow and steady. I think
Right.
people are just kind of worried about, what's going to happen overall, and they're just being a little bit more cautious. I mean, there's still listings that are new listings that are coming. Obviously, not as many as before because people are a bit apprehensive. I'm going to put my house on the market. Are people really going to qualify with these interest rates? But again, it's always about, finding the right agency to help you, finding the right lender to help you to answer those questions so that if there is a need for that listing to happen, that you have the right information. Now, just kind of briefly, don't want to miss out on mentioning this while we can. Going
Okay.
back to the ADU,
Yep.
I have a client that we're working with, and something that was really interesting for LA County, and I'm sure for other counties as well, there are some grants that are available for those people. He applied for a grant, and he received $40,000 towards his development of the ADU unit for his home. That's a huge help.
Yep.
Especially because, ADUs are not as inexpensive as they used to be because cost of materials, cost of labor.
Right.
But it's still an overall great deal, I believe.
No, I agree with you very much. Connie, we're up against it. I'm sorry to say. I wish we had more time. Have you back soon. Go for 2023. I hope we have a terrific year. Thank you very much for coming on the show.
Thank you, Jeff. Always appreciate it.
Thank you. And that's Connie from PMA. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us each and every week as we come to you to try to help you make decisions, the better decision that you can make, the best decision you can make for your purchase or your refi, especially January 2023. It's been a tough year, to say the least, the last year, especially the last 6 months in the mortgage industry, as we've seen rates climb to unbelievable high, especially since at the beginning of the year they were so low. And we also couple that with inflation, which is eating away at people's paychecks, even if they are getting more money, which is another thing that stops people from buying and refinancing loans. And of course, you have the Fed, which is trying to kill inflation, raise their own particular short-term interest rates to their member banks, which in turn, those banks raise their rates on car loans, on credit cards, on any number of other financial products that you, on a daily basis, need in your life. Now, you currently have a mortgage, and you probably have a rate that is smoking. So you're not going to want to change that rate. You're not going to want to do anything other than to enjoy your low payment and to obviously take advantage of the low rate environment that you borrowed in. However, if you've got certain things that go on in your life, I'm an old guy, so in my house, it's medical. This is all we talk about, ailments and medicines. But those particular things cost money. Now, if you're sitting on equity within your home and a low interest rate, what are you supposed to do? There are plenty of things that you can do. Certainly a home equity line of credit, that's a good thing you can do, where you keep your low interest rate, but you are able to tap into the equity in your home at this new rate, but possibly not at the particular large volume. Most loans are hundreds of thousands of dollars, and usually on a home equity line of credit, you can get something for $50, $60, maybe $80, $100,000. That's a good way to look at equity in your home without touching that really good low interest rate. However, you may be one of these people who say, look, I need the equity, larger chunk of it, take it out of my house so I can use it either for investment or for putting in other kinds of real estate. There are a lot of reasons why you want a big chunk of cash. To do that, you would have to look at the marketplace and say, okay, where do I want to be in X amount of years when it comes to this mortgage? Now, do we in the mortgage business see rates coming down or continuing to fall? They were at 7.5%. We're now at 6.5% on a 30-year fixed rate loan. Just as an example, do we see it at 5.5% in 6 months? Well, I'm a pessimistic guy when it comes to rates and how people should be looking at their investment in their own property. Always be conservative, always be protective of whatever you have, as opposed to gamble on something that you don't have. However, do I think they're going to come down? Yes, but not to 5.5%. I think if you see a short-term interest rate, mortgage rates on a 30-year fixed rate at about 6%, 5.75 to 6%, that's about where we're going to see it as at its lowest this year. At its highest, I think we've really settled into this number, mid-sixes for a while. Reason being is that we're seeing inflation come down, and that's a good thing. And it's a good thing because obviously things costing less and not having the worry that things are going to continue to spiral out of control. And that's the worst thing when you're trying to figure out your finances. If you feel you're spinning out of control, i.e. you have no control over what the gas prices are, what your home heating oil prices are, what food prices are, clothing prices, education, all of these things have been really going up and up and up last year. But we've seen gas prices fall to their lowest level since the pandemic started. Here in Southern California, that still means pretty high. But for the rest of the country, those people that do listen to the show who are not in Southern California, they're going to say, hey, you're right. Prices for gasoline have really fallen, and that's really helped. Now, what can offset that? The war, China's re-entry into the economic world. All kinds of things can affect that particular calculus. All right, let's get into a couple of the news to use items. And really, they're kind of topics that I had to throw out there just to consider, because it's very, like I say, it's beginning of the year and things to get your feet wet in terms of where information comes from, how you consider that information, and then the best ways to make decisions. Obviously, getting the information is always the most important part. So where do we get our real estate and mortgage information? A lot of people get it online. And so social media and real estate has become a huge part of the business, whether it's Zillow online, whether it's any number of different, Redfin, certainly. We read a little bit about their CEO, their CFO, what they think is happening in the tech world in terms of real estate and real estate prices and how the information about what's going on there. As we talked earlier in the show about the macrocosm of the investment world and the different levels of that. In the real estate world, it's like that too. As I said, Zillow is certainly have their economists out there telling us what's happening. And certainly the people at on any number of these websites, whether it's Facebook or Instagram or TikTok or Twitter or LinkedIn, they all have their gurus too, and the people that call themselves influencers. Are you plugged into these influencers, and do these influencers really influence, or do you just listen to them and ignore them? Most of the people in all of these spaces who claim to be knowledgeable are taking a page out of the, let's say, they're really anti what's in the establishment. And that's what makes the push towards your information gathering on all the social media sites dangerous. There is an establishment way to look at real estate prices, to look at mortgages, and it's very much as we talk about each and every week. You look to the Fed, you look to Market Watch, and I go to, like I say, Housing Wire and a number of other websites to get my information. But they're very standard places to go, whether it's MSN where you go, whether it's on Yahoo Finance, places where a great majority of people get information about what's going on in the financial world, what's going to help you make decisions about getting a mortgage, about buying a house, about getting into any kind of investment real estate portfolios. Then you have Facebook, Instagram, TikTok, Twitter, LinkedIn, and any number of other social influencers that talk to a great number of people, but the information is anti what the establishment is. So if the establishment is saying, hey, you shouldn't buy Bitcoin. You shouldn't buy any of these types of cryptocurrency. And Bankman-Fried is saying, you should buy it. Well, the danger is, well, everybody sees what happens to FTX, right? And there are still a number of people out there who support cryptocurrency or or that type of investment. But that's really anti what the stock market people. Now, I agree, the establishment in all these areas, whether it's political or whether it's financial, and whether it's the stock market or the real estate mortgage world, is suspect. These people are into making money, and you have to take what they say and really sift through it to find what is true. But on the flip side, if you think because somebody on a social media channel says, hey, this is the newest, hottest, really be careful. We've all seen the Bernie Madoffs of the world take people to the cleaners, and we've all seen this particular gentleman do the exact same. And there are many more out there in that world, because the suspension of belief based on the information that you're not getting because it's misinformation in that particular world is really dangerous. Now, if you're one of these people like me who investigates both sides and comes to their own conclusion, I'm in the business. I've been in the business 30 years. I really know what's going on. And I also can be sold a bill of goods, no question about it. But for the most part, I am very conservative in both my investment and the way I look at how things are. I suggest you do the same. I know nobody likes unsolicited advice. Thank you very much, my therapist, for telling me that. However, in the radio world, that's exactly what you're looking for. And the advice is be careful, be cautious. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week, we bring to you information that helpfully gets you to where you want to go this year in the real estate and the mortgage world. I know rates have gone up. I know that's not a great sign. But there are some opportunities. There are some things that you can do with which to set yourself up if prices fall dramatically. And you're out there, you're looking for a home. You've been looking for a home. You went through the time where you had to fight with 15 other offers at the same time. Well, we may see some real estate prices fall. There is prediction of 15 to 20% in a number of different markets, and we certainly are going to see rates fall somewhat. We've seen them come off their highs. They were one thing, now they're down in about 6.5 for a 30-year fix. That's a point less than their high was, the high that they were last summer. Now, one of the things that we've seen in the marketplace recently, and I have run into it in what they call an EPO. An EPO for mortgage lenders means that if somebody pays off or sells a house prior to 6 months after the loan is done, the money that is lost by the company that sold the loan to Freddie Mac or Fannie Mae has to go to the broker or the company that originated the loan and get reimbursed. That's in all the contracts in all of these situations. So EPO, yes, it smacked me in the head. So we dug into it really a lot, and we tried to figure out what the heck happened, because the borrower paid for the commission, so we knew it wasn't a loss as a result of that. But why, in fact, did the property owner refinance? So we dug into it, and what we found out was, no, the property owner did not refinance. There was an issue with their employment, and they ended up having to sell the property, but they had to sell the property at a loss, $100,000 loss. And we were aghast. We were like, what? Well, how did you sell a property at a loss in a market? Well, in many markets around the country, what we've seen is the value of the property has declined over the last 90 to 180 days from when they purchased the property. So therefore, because they had to move, the job situation changed, they either laid off or they were being relocated. The property that they bought at one number, let's say $500,000, property is now worth $400,000. So what happens in a market, and we talk about it a lot on this show, what happens when the homeowner has to sell a property at a loss? In 2008, lots of times we did that. We had to sell the property at a loss because the property just wasn't worth it as much as it was when they bought at the peak. That's what's happening now. The peak of real estate prices were let's say June of 2022, where prices had reached the pinnacle in every area. Now, 6 months later, prices have come off so much that this particular borrower lost $100,000. Now, are we going to have to pay that EPO? I don't know. We're working it out anyway. The point of the story is that if you're in a situation right now where you have a property that you are underwater on, term we haven't used in a while, underwater meaning you owe more than the property is worth, what are you to do? Now, back in the day, and we're calling the day 2008, 2009, 2010, people would just walk. Hey, I'd rather have, a bad credit than have to pay on a property that isn't worth what I'm paying for. Now, made some logical sense. In this market, I'm not quite so sure, and here's why. We're looking at possibly a 15 to 20% reduction in the price of the home. Now, if you bought the home in 2019, from 2019 to today, there's been a 38% increase in the value of your property. So anybody that bought a property in 2019 should be okay, even if you have 15 to 20% reduction in the price of the value of your home. You should be okay. You're still, making money on the property. So those loans should be pretty good. So we're talking about loans then, let's say 2020. No, those loans should be pretty good too. So really we're talking late 2021 through mid part of 2022 before prices started to actually fall again. So for about a year, we had a number of homes that were sold. Should those people panic or walk away? No, I don't think so. The reason is because this particular economic cycle, depending on how you look at it, what news you look at, we're not seeing the type of unemployment numbers which would drastically alter the value of your home. Meaning that people who are unemployed probably aren't going to pay their mortgage. That's what I'm talking about. So we're seeing people continually work. The labor market is still tight. And so if this holds through what we're considering now coming out of a recession that happened last year, the 2 straight quarters of downturn in GDP, if that is true, then we should see an increase in prices, or at least the value returned to what they paid for it within a couple of years. Now, if you were back in 2008 and you were underwater and you didn't have a job, well, obviously you're not going to pay your mortgage. You can't. Well, that happened to millions of people at the time, which is why the housing market crashed the way it did. The housing market in this downturn, in this particular cycle, it doesn't appear to be like that. The loans are good, so the banks are solid. The lending standards have remained tight, so future loans are also going to be solid because the way you qualify for a loan is more difficult than it was back in the 2008 cycle. So for those people who bought during that limited window, unless you're planning to move or you need to sell because you have a downturn or you lost your job, because there will be some layoffs, that's for sure. You should hang on to that house because you're going to see prices improve. Now, we haven't even talked about it, but inventory is at a low point again. We have seen no improvement in inventory. Builders are not building the way we need them to build. We need 1 million to 2 million new houses right now in order to satisfy the demand out there. And obviously, that would lower prices too, right? So if you're out there and you're thinking about walking on a loan because your house is not worth what it was when you paid for it, think again. The value of that property will be more sustained when we get into the year further. Now, maybe not this year, but 24 is when a lot of predictions are that the housing market will come back. Now, I know nobody can predict what's going to happen next week, let alone in 2024. But if you look at it historically, you will also agree that these particular cycles last about that long. And because we're looking at already coming out, some economists are saying, of the recession because it happened last year, what we're looking for is an improvement in not only inflation, not only job growth, which could happen as a result of coming out of the recession as opposed to going into the recession. Anyway, hang on to your house. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show this week and every week. Go to YouTube if you want to see me. You want to see pictures of me and my smiling face. Jeff Barton, the mortgage voice. And we'll see you next time. Thanks.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
You're listening to KCAA, your good neighbor along the way.
Taheebo Tea Club's original Pure Pouty Arcos